To get our next panel underway, everyone, I would like to invite Trish Metz from Eagle Technology to come and address us. Welcome, Trish.
Good morning, everyone. It's a real pleasure to introduce Eagle Technology to the ICNZ conference and as proud sponsors of the regulation panel discussion. It's actually our first year here at the conference, and so I thought I'd better just explain a little bit about who we are and our role in supporting the insurance industry. So Eagle are the exclusive Esri distributor for New Zealand. We support well over 800 customers across both New Zealand and the South Pacific in their use of Esri's world-leading geospatial platform, ArcGIS. So I'm seeing a few nods in the audience, but I suspect there's many of you who may not have heard of Esri or ArcGIS. So we'll take an example in the insurance space where you as an insurer need to understand your accumulation risk. You want to be able to understand your ability at quite a fine-grained geography, your ability to take on further policies. So to do that, you need to be able to map your risk to a location, to a building. You then need to be able to daisy chain buildings together, other buildings that you insure, to get a really fine-grained understanding of your accumulation risk and your ability to take on other policies. There's, of course, use cases across climate change, where geospatial technology, of course, has a really important role to play in being able to model out climate change risk, both over time, across different perils, and at various returns. And our customers are using ArcGIS to do this important work. Looking at regulation, ArcGIS can support the creation of transparent risk-based pricing policy, with that accurate location-based information. It can enable reporting on accumulation at concentration, and also looking at natural hazard risk as well. So look, we're really excited to be here. We do feel we have an important role to play in the industry in providing the technology to help you guys face the challenges that we face as an industry. So look, come stop by the booth. We would love to meet you. We've got some exciting demos to share, and I look forward to continuing the conversation with you all there. So please come by and say hello. With that, I'll hand back. Enjoy the panel discussion and the rest of the conference today. Thank you.
Thank you very much, Trish from Eagle Technology. And a reminder, you can go and check out all of our sponsors and exhibitors upstairs and be in to win a $100 Prezi card as well. Now, the government is committed to reducing red tape and the regulatory burden on consumers and businesses and provide more coherent and optimal outcomes for New Zealanders. There's a widespread support to move to a regime that reduces duplication, removes undue compliance costs and improves outcomes for consumers. Regulation needs to maintain a high level of consumer protection while allowing insurers to react, adapt and innovate to meet evolving consumer expectation. This requires coordination between policymakers, regulators and insurers. We heard about that in our previous panel. Regulation needs to recognise the unique purpose and nature of insurance arrangements and seek to minimise the compliance burden on businesses, which can create excessive costs that are passed on to consumers. Insurers have taken the opportunity to reset the relationship with regulatory bodies such as the Council of Financial Regulators to assist with the business as usual of the regulatory environment, but also to ensure regulators and industry are preparing the ground for the longer term challenges such as climate change and the impact that will have on our sector and our customers. As always, the devil is in the detail. So it's my pleasure to introduce our second panel to the stage as you hear your introduction. First, Christian Hawkesby, the Deputy Governor and Head of Financial Stability at the Reserve Bank of New Zealand. He's been there since 2019, Prior to his appointment as Deputy Governor, General Manager Financial Stability Group, Christian was the Assistant Governor and General Manager of Economics, Financial Markets and Banking. Before joining the Reserve Bank, Christian spent 9 years at the Bank of England, where he held various senior positions, including Head of Market Intelligence. Lovely to see you. Thanks for joining us. Adam Heath, Chief Executive, FMG. He joined in December 2021. In his previous role, he was the Executive General Manager, Insurance Solutions with Suncorp New Zealand. Adam has a strong background in general and life insurance, banking and telecommunications, and has a real connection to and empathy for FMG's purpose, vision, values, the mutual model and the rural sector. Helen McNeil, Chief Risk Officer for Suncorp. She provides risk support and oversight for Vero Insurance, Vero Liability, and works closely with Vero's joint venture partner, AA Insurance. Helen is accountable for risk-related accountabilities, including regulatory affairs, risk compliance, quality assurance, and fraud detection. Helen has been with Suncorp New Zealand since 2008. So welcome to Adam and to you, Helen. Joe Kelly, Chief Executive, Centre for Sustainable Finance. Joe has delivered cross-continent sustainability initiatives between some of the world's best-known business leaders, including the B Team, a global business leadership collective. She's previously been a board member of BLAB ICNZ, the non-profit organisation that supports the Australasian community of certified B Corps, and the New Zealand Impact Investing Network. I'm going to ask now to kick us off Christian Hawkesby to come and set the scene for us. Round of applause, please, everyone.
Morena koutou, kia ora koutou katoa. I thought I'd just start with two disclosures. One is that I've had no role on who is on the panel for the regulation session. So Michael Stasny mentioned earlier that he would have loved to have been here. I wasn't holding that back. I had no say in that. In actual fact, I sat through the session earlier on, and I would have quite liked to have been on that panel, actually. If he wanted to swap, I would have taken up that offer. Second disclosure is this is a regulatory panel. I'm the regulator on the panel. I'm wearing a tie to prove that I'm from Wellington, just so everyone can identify everyone. But in my mind, we're a small country, we're a small industry. Many of us have worked in the private sector and the public sector in the past, and any one of my panellists could be, sitting in my seat and vice versa. I think my attitude is that we're all in this together ultimately. And so to me, a few words to kick off. The insurance industry is not only important for our economy and our financial system, but it's fundamentally important to the functioning of our society. To me, there's something inherently human about our desire to avoid risk, manage risk within a risk tolerance, and often that means sharing risk, spreading risk until it's held ultimately by those most willing and able to hold that risk. And this is something that we've been doing since the beginning of time. It's the reason why we've lived in tribes, why we live in communities, why we live in countries, to share and spread that risk around together. And for those of you who are interested in history, the first written record of an insurance contract goes back to 1750 BC in the Babylonian Empire. So we have literally been doing this for almost forever. And so the insurance industry that we see today is really just a continuation of that, but looking to do it in a more innovative, efficient, effective way. And we've just been getting better and better at it over the last 200, 300 years. But the success of the insurance industry is based on, for this to all work, it's based on trust and confidence. And great to see the session later on today focusing in on that, and that's trust and confidence that can be bought by both the industry and regulators as part of that. Two ways regulators fit into this story. One is for all this to work, people need to understand the products they're in, they need to be in the right products, and that's really about conduct regulation and the FMA. Secondly, people need to be able to be in a position where if that bad situation occurs and a claim needs to be made, the insurance industry needs to have that resilience to be able to be there and make that claim when it's required, and that's integral to this whole thing working. And so that's where the Reserve Bank fits in as the prudential regulator of the insurance industry to provide that trust and confidence as well. So far so simple. What are the challenges for us collectively as an industry? Well, one is that the insurance industry is complex. There are so many different players, wholesale providers, retail providers, different brands, reliance on global insurers, often a reliance on overseas parents, moral hazard and adverse selection hiding behind every shadow, the role of actuaries, the special role of actuaries in the industry, which in total can make the industry impenetrable to those outside of this room in some ways. Secondly, and discussed earlier, New Zealand has unique risks. We have our seismic risk, volcanic risk, and increasingly the risk from climate change, which we discussed at length earlier. Which really brings into the third challenge, and that is that this is a team effort. We have private providers, we have the role of the public sector through the decisions of local and central government. We have the Crown as the ultimate, backstop in the most severe risk events. So that all leads to this challenge that we have, that we need to manage this as a system collectively and collaboratively with that leadership. So what's the Reserve Bank up to? I'll just mention three things. One is that we are part of that leadership in the industry, so the Council of Financial Regulators, which we co-chair with the Financial Markets Authority, joined by the Treasury, MB and ComCom. And I want to call out in particular ICNZ for their role in the CoFR Insurance Forum, which is really our opportunity to get both regulators and the industry together. Secondly, the Reserve Bank's taking an increasingly system-wide view when it comes to insurance and the importance of insurance, not only for the industry but for the stability of the financial system more generally. So if you went back a few years, a stress testing program from the Reserve Bank was all about whether the banking industry could cope with higher interest rates, higher inflation, higher unemployment. Can the financial system withstand that? Increasingly, our stress testing program is actually more about can the banking system and the insurance sector cope with different climate events, different weather events, climate scenarios, and in the months to come we're publishing our first seismic stress test for the insurance industry. We're also talking increasingly about insurance issues in our publications. So last year we talked a lot about risk-based pricing. My sense had been that the insurance industry almost didn't feel like they had permission to talk about risk-based pricing. It was something that was taboo. So we got out there and highlighted the benefits of risk-based pricing, the way that it creates the right incentives for risk to be identified, measured, managed appropriately. But it does bring forward some of these really tough questions about accessibility. Finally, as a prudential regulator, we are in the process of reviewing the Insurance Prudential Supervision Act. That's a process that's not about, more regulation, forever more red tape and compliance. It's really about having a regulatory framework that is fit for purpose for the modern era that we're in. We're dealing with an act that's 8 years old that isn't really fit for a modern, effective international approach to insurance regulation. So that's what we're up to. Are we the finished product? No. There is more things that we need to do. The IPSA review has taken too long. We've had too many amendments of the solvency standard. We know that there are things that we need to do better. But the point that I want to make to you all is that we are committed. We are committed to lifting the game. We are committed to our engagement with the industry, and we're committed to working with you all together. No te roro, naka te roro, kai ora ai te iwi. With your contribution and our contribution, the people will prosper. Kia ora.
Well, ngā mihi nui kia ora for that. Just a reminder to everyone, we will have our Q&A session. Make sure that you put your questions in if you want them to be addressed to a particular person. Pop that in there too. Also, you can upvote the questions that you want to have asked the most. So if you see a question in that lineup, you think, oh, that's something I would like to ask, make sure you vote for it and it will come up the queue so that I can see them in order of your priority. And our panellists, of course, if you want to jump in, please do. I think you've got one there to share and just one there. I think we've got two. Just one, have we? Oh, if we've got any other mics hiding around there, guys, if you can bring them up, that would be great. I think we had one extra before. Hopefully I'm not sitting on it. I don't think I am. But anyway, let's get underway. Are we wasting, let's start with you, Christian. Thank you very much for addressing us. Are we wasting too much time on regulation, not spending enough time on action?
I think that regulation is important in the sense of having, here we go, more do we pass it down the chain? I think my point is that we need an effective modern regulatory environment to achieve the outcomes that we want to achieve, and that there is a lot of, in your introduction, it's all about, regulation, it's a bad thing, it's a distraction, all of this, can we have less of it? What I'd say is that we want to have a better, more effective regulatory environment so that we can all get on and do the things that we need to do. The Insurance Prudential Supervision Act is 15 years old. It's antiquated. It doesn't really work in the current environment. You take the CBL failure, for example. There's lots of reports on record about things that we could have done better, things we should have done better, and the way that the regulatory environment needs to lift to enable that. One of the most extreme, examples is that both in insurance and in banking, we have regulatory environments where for the regulator you can effectively, license an insurer and you can de-license them. It's a very sort of nuclear type environment, and so we're trying to build one where actually you can be more proportionate, you can be more, have more gradations of the actions that a regulator can take, and so building a framework around that brings benefits, it brings transparency, it brings more consistency to the way that we operate.
Do you feel like there has been too much? You said it's antiquated, the regulatory settings are antiquated. Has there been too much red tape?
I think the challenge really is probably less narrowly around the Reserve Bank and its prudential regulation, because if you look at us internationally, internationally we have a very light touch approach to regulation, and we stand out internationally when you kind of compare our approaches. The challenge has been more around how it all adds up, and I know my friends on the panel will mention this as well, that there's prudential regulation, there's conduct regulation, there's all the other aspects of regulation that there are. And I think that's the challenge, how it all adds up in totality and how all the regulators talk to each other and how we collaborate and communicate. And so that's where the Council of Financial Regulators has been really important to get us around the table. When I first came into this role 3 years ago, there's a lot of heat on, there's too much going on, it's all at once, you're not talking to each other. So that's when we started putting together a regulatory initiatives calendar where, all of the regulation across the industry is in one place, it's set out, and we can, look at the consistency and timing and how that all fits together in totality. Our relation, I just want to also talk about our relationship with the FMA, which is very tight. We actually have a stall here, a joint stall at the conference, so I do encourage you all to continue the conversation and chat. But we are tight at every level with the FMA. Each leader and manager has a key relationship, so there's
In lockstep.
We share information to the extent that we can legally.
Okay, let's come to the rest of the panel. So you've heard Christian speaking this morning. If there was one thing that you could change about the current environment around the regulatory settings, what would it be, Adam?
It would be the level of intensity. So I must admit, when you're thinking about the one thing, it's always a powerful thing to think about. But I think underlying that is several factors: the sheer volume of regulation, the pace of regulatory change, and the unintended consequences that arise, which I think is linked to the pace. So
Christian says we have a light touch relative to international settings.
Yes, I believe that's a fair statement. Yeah. And particularly in terms of the Reserve Bank. In fact, the Reserve Bank, and I'm speaking respectfully here, has probably come up for criticism from other commentators like the International Monetary Fund in previous years around not being active enough within the financial services sector. But I think your question around are we wasting too much time? I don't think we're wasting time, because generally speaking, all regulation is well intended. It's intended to deliver better outcomes, more transparency, more fairness, etc. But I do think we're spending disproportionately more time on regulation than we should be, compared to other programs of work that we would like to progress.
Okay. Number one being?
Pardon?
Number one?
Initiatives that drive real value for clients. So the panel earlier talked a little bit about innovation, but we are constantly struggling with how do we find the time to think innovatively and to challenge ourselves and to look for innovative ways of doing things, because generally speaking, and I don't want to speak for my peers and colleagues, but anything that comes into our organisation that is of a regulatory or a compliance-related nature goes to the top. So that gets priority, it gets the best resources, it gets the best people, it gets a significant amount of funding. We don't have to go through a business case process, we just have to do it because it's a regulatory requirement. So when you have your pipe, for want of a better description, is starting to get full of those things, it's the classic metaphor around the big rocks, the pebbles in the sand. More of those big rocks have a regulatory and or compliance label on them than I believe we should have.
Okay. Helen?
Yeah, I think the one thing, that proportionality, I think that's just so important. The regulatory environment is just fundamentally important. I don't think no business person I've ever met says we shouldn't have it. In fact, I think we can be very proud in New Zealand of, the stability that we have, that we've been able to enjoy. We've come through some, very serious weather events in recent years, and before that, the terrible earthquake scenarios that we have had and likely to continue to have. But trying to get that balance right between actually having that framework that's there, but isn't intrusively there and isn't just constantly being ratcheted up without undertaking that real cost-benefit analysis. What problem we're trying to solve. And I sort of echo actually what Adam said in terms of, so my role as Chief Risk Officer, I don't know if Ben's still here. I'm glad to get the invite as well. He might be off painting the town beige. That's what we do. But I'm conscious in the the board meetings and things where a significant amount of the reporting that I'm taking through to directors is around upcoming regulatory change, change that's currently in process of being implemented and how we're going with that. And then the amount of time you're able to spend on the risks around actually what are the strategic risks we're facing, where do we get that growth, where do we get that innovation, is disproportionately a different part of that conversation. So for me, if that's one thing we could all focus on, and I take Christian's point, it's a collective thing, we need to lean in and help get that balance right as well by helping with data and information and other things. But that would be the place I'd love to see us all get to.
What about for you, Joe? If there's one thing you could change about regulation, what would it be?
Yeah, so I guess just to introduce the centre, it's not so self-evident what our role is. So we were established 3.5 years ago as sort of an honest broker or an intermediary between financial institutions and the government, and also across the sector. So we work with the Bankers Association and the Insurance Council, but we're an independent organisation with an independent board, and so we are able to get sort of in the tent on policy development and helping to facilitate conversations around regulatory approaches or settings. And that's sort of evidence, I suppose, of the fact that there is a general sense that in the context of sustainability or long-term resilience, that the settings aren't quite right, and that there weren't the mechanisms in place to have the trust and confidence and the conversations with each other about it. So I think what I would change specifically at the moment, what we talk about a lot with our colleagues in the government, is the coherence. So we really need to know where we're going as a country and what our objectives are over the kind of mid to long term, whether that's going for growth or infrastructure investment or climate change strategy or adaptation framework, or, we need then the kind of regulation and the policy to flow from those national level objectives. So that would be, for me, the ask, I suppose, is that there was sort of galvanising frameworks and, ambitious statements, and then they sort of flowed through into how the settings are organised to support those.
Christian, how do regulators balance business as usual activities against future activities in the environment that they operate in?
Well, it's part of the sort of operating model of a regulator internationally. We have a very standard one around there's some business as usual run activities. We need to set the rules, supervise against those rules, enforce against them, resolve when things go bad in the industry, be involved in that resolution. So we have dedicated teams to those functions, but equally we have dedicated teams looking out into the future in terms of what are the risks on the horizon on the a year or two ahead. What is the state of the financial system at the moment? What does that tell us about how we should be doing that run differently? Increasingly, we're taking a longer and longer term perspective on that horizon scanning. What are the things out 5-10 years ahead? What sort of conversations should we be having now? Much more of an emphasis on thematics coming through, and so risk-based pricing being a classic one. How can we shine light on those issues and really allow permission for those conversations to go on?
Do you think there needs to be more coherence, less intensity in the settings?
In our settings, I mean, it was good to listen to colleagues on the panel. It's really about getting the balance right. I think we're never going to live in an environment where there's no regulation going on and no regulatory development going on. There's always a sort of a care and maintenance, and things progress through time. So I think it'll always be there, but it's striking that balance that how do you keep that going while you walk and talk at the same time, sort of thing. We need to be able to do more than one thing. So how can we keep the innovation, the client focus, and all of those things going? Part of that is around, as an industry, being focused on where the best cost benefit is. Another part is just the industry having the resources to do those two things at once. So, I get this a lot talking to the banking industry as well. We need to be able to do more things at once. We're making a really big push in terms of our engagement with the industry, getting more DNA, insurance DNA in the Reserve Bank, because when you think about the Reserve Bank, we are a bank, we're a central bank, we're a bank, have been for 90 years. We've regulated the banking industry for decades. We're 15 years in as the prudential regulator, so there is less insurance DNA in the building, and that's something that we're really focused on pushing, expanding, and so that it really builds that mutual trust and understanding to be able to have the sort of conversations that we need to.
So let me come to Adam then. Is the cost, you talked about the intensity of the regulation, is the cost of regulation too much?
Yeah, in answering that question, maybe I'll put some facts on the table and people can come to their own conclusion. And I think the interesting piece that Christian raises is it's the impact of multiple... Is it on?
Yeah.
Yeah, sorry. Multiple regulators and the costs associated with those. So at the moment, many in this room will know we're working towards implementing some changes to the fire service levy, and there's been a whole bunch of conversations and discussion around whether insurance is the right way to fund that. We've just finished a submission for some proposed changes to the NHI, the Natural Hazard Insurance Levy, and within that is a proposal to lift the current cap from 300,000 to 400,000. Now, ultimately, and I won't speak for peers and colleagues, but we've done the modelling. We said, well, okay, if those changes go through at the level that they're proposed, so NHI is proposing a 50% increase in the levy, and that's off the back of NHI levies having gone up 40% in the last 12 months. So, and that's due to land at the same time as the changes to the fire service levy. So if that all transpires as has been proposed, effectively for our average home premium, we'll effectively see the combined impact of taxes and levies be circa 43% of our clients' premiums. So you're effectively saying for every new client that signs up for a homeowner's policy with FMG, they're on an effective tax rate of 43%, which would be the highest tax rate in the country. The challenge with that then is when we then look at what we need to do to continue to make insurance affordable for our clients. And our purpose for 120 years is to deliver a better deal for rural New Zealand Aotearoa. So we were created to actually keep insurance affordable and available for farmers and growers. And so those combined taxes and levies are now 3 times our controllable operational costs. So you add our overheads together and our profit margin, actually taxes and levies are 3 times that. And the proposed NHI levy would be roughly equivalent to what we pay out in claims alone. And so, and as a mutual insurer, we typically operate at a loss ratio that would be circa 20% higher than most of our industry peers. So we're looking there and saying, well, hang on, most of the regulatory intent is to keep insurance affordable and available, but government now is 3 times more a driver of cost for our clients than we are. So how can we control that cost, further reduce it? And the whole reason clients purchase an insurance policy is for the promise we make to deliver at claims time. I don't think they necessarily buy it to say, actually, okay, how am I then helping to fund the NHI scheme, even though that is a critical part of delivering at claims time at time of natural disaster.
So what do you need to hear today?
What I'd like to hear is a more, and this is the case of the unintended consequences. So these are concatenating effects. So I get and understand all of the reasons why NHI need to lift their levy, because they are now the 2nd largest buyer of reinsurance in the country. They buy $9.2 billion worth of reinsurance, and that's good for the country and it's good for us. But when that intersects with the fire service levy, and the fire service is a critically important function, does social good, needs to be funded by somewhere, but does this all have to come out of insurance? And then you put tax over the top of both of those levies. So, you know, an $11 billion industry is generating close to $5 billion worth of tax. And when we talk about the criticality of insurance being available in one of the riskiest jurisdictions on the planet, can we then hold the mirror up to ourselves and we're doing everything humanly possible to keep insurance as affordable and as available as we can? And I just don't think we do. And that's the linked up piece, right? So everyone individually is doing what they think's right for their own business or department or area, but who's then stepping back and spending time in the shoes of the client to then say, how does that then all land? And is that an acceptable outcome? And is that going to help New Zealand society And chances are the answer is no.
Yeah, when the costs are 3 times higher, it's a real concern, isn't it? Helen, do you believe the prudential requirements balance customer protection with costs for insurers?
Oh, look, I think Adam's answered very well the sort of tax input angle, but again, to his other sort of point, that just the cumulative effect. It's not just the NHC and the fire service levies that we're dealing with. It's just that volume of change. I talked to my 8-year-old about pocket money and about learning how to budget for a household. And, you have to pay your mortgage and you have to pay your rates and you have to pay your insurance, water bills, you've got to have your food. Everything needs to get done before you can spend money on fun things like innovation and growth and other things. And at the moment we're dealing with the CoFR implementation, the climate, mandatory climate reporting, the levy changes that we've just talked about. We've got privacy changes coming through. We're dealing with IPSA changes, the solvency standard changes, the Insurance Contracts Act stuff, which is the biggest change in 30 years. All of this happening at once. Holidays Act, companies changes, director duty changes. Like, it is literally just a storm of things. And is it too high? Because you might argue that each of those are not necessarily bad things to do. But back to how do you actually absorb all of that and still actually deal with, frankly, what the biggest problem I think is in New Zealand at the moment, which is just sheer affordability of insurance. When we're spending that amount of money just being compliant, not even spending our household budget on the other bits and pieces that we want to be spending it on. So it's a challenge and something that, again, we all need to lean into. And it's certainly not just RBNZ's fault. It is an entire sea change across New Zealand about how we're structuring ourselves as a country, the expectations we're putting on businesses, but particularly on insurers, at the same time as while we're fiddling over here, Rome's burning. We just have to face into that, I think, and get a bit more realistic.
So I hear you saying it's not just on the Reserve Bank, but if you were to pose a question to Christian, what would it be?
I think the CoFR, which Christian's referred to, that absolutely has been a significant step in the right direction. Just even that recognition that actually, there is this, cumulative impact with a whole variety of different regulators with important but slightly different mandates and reasons that they need to engage with industry is really great. Now, for me, it's that, how do we take it to that next level, which is to actively manage it? So rather than just recognising that's, the issue, it's how do we actively manage it and make sure that it's also recognising some of the other entities that we deal with, NHC and FINS in particular, aren't even part of CoFR. So again, for us, it's still only part of the story. And so, it's the classic, you put yourself in other people's shoes and try to work out how do we actually have those conversations in the way that would make it more straightforward for the people who have to implement it, and have a chunk of the subject matter expertise to make sure that we avoid the unintended consequences of change when they're coming through. So it's that beyond the recognition to the how do we fundamentally work together to change it so that we sequence things properly, we put our attention on the right priorities rather than just doing everything at once.
Your response, Christian?
All good points and good conversation and just, listening to it, take the point about, there's more players involved. I'm looking at Chris actually in the sense of the CoFR Insurance Forum is something that is a real opportunity because it takes not just the regulators around the room, but it's okay, let's connect up with the industry and actually work together. And at the moment we've got industry bodies on there, but I think there's an open question, do we have the right people in that forum, extending out to the names that have been mentioned this morning, to have that conversation to be completely joined up. We need to get away from the bilateral conversations and more of the system view. We also have Treasury and MB on CoFR as well, and they've got a really important sort of system role to play in the sense of how does this all fit together, not just prudential conduct and other, how does it all fit together? I think the prioritisation point is a good one, and just speaking for the Reserve Bank ourselves is that you can get into the ideal situation is where you can have sort of a good regulatory system where there is care and maintenance through time, not one that gets neglected for 10 or 15 years and then suddenly you're trying to
Just move the mic with your mouth.
So I always move my
We're
hands.
getting- I love
My
it,
hands.
but-
I'm a hand mover. We can't have an environment where we neglect care and maintenance for a long time, and then suddenly there's a lot of catch up, and it happens that other regulators are trying to catch up too. So it's getting that prioritisation right, so it's a more of a
Do you
an
agree with the
even flow.
characterisation of it being like a storm, as Helen said? It's a storm of things.
She certainly laid it out like that, Helen. You did a good job of painting the picture of a storm. And so I do have sympathy in terms of how much is going on. I accept that. So the coordination is important. We have the platforms there where we're making a start. We've got the forums. We need to build. We need to build on it. But I guess my point is, we also need to be cognizant that regulatory change and upkeep and care and maintenance there are always going to be things on the go.
Yeah.
So we can't think that we're going to go into a completely different world.
Let's come to Joe. Do the current regulatory settings fit with long-term challenges such as climate change?
Well, I think that was sort of part of what my answer was earlier. If they did, then you wouldn't need organisations like us to sort of, get amongst it. It's dynamic. I mean, the regulatory environment isn't static, and so I think that what we hear is that in order to have a regulatory environment that can respond to climate change, we need to really work together and draw out all of the expertise that we have both in the government and the private sector to really think about how we're understanding the risks, understanding things, looking forward rather than looking backwards, and thinking about how, if in the context of climate change, the centre's baseline is that we need to move a lot of money really quickly into new things, new areas of the economy, whether that's transition activities, so things that enable other industries to go green over time, or things that already are green, or things that are just less risky. And so if we need to do that in the context of exponential new risk, then you sort of have to keep moving. So I don't know that the settings ever could be fit for those types of challenges, because we don't necessarily know what they are. But we've got this enormous task of having to transition the economy, stay attractive to international investment, and retain our access to markets and customers. So that means we have to move a whole lot of money, and we have to do it all while maintaining system stability. And so I think it's just, the answer to that question can't ever really be yes, because the externals are moving so much that we just have to keep moving with it, I think.
So it can never be fit for purpose because we need to keep moving. That's what you're saying?
I just think
adapting.
it would be hard to say yes, because everything in the world is changing so quickly and it's so dynamic that we just have to keep up. So yeah, if you've got regulation that was developed 15 years ago, chances are it's probably going to need a dust off and a refresh. And in the context of climate and the disclosures, this is so new in the world that we are just going to have to keep adjusting them over time and making sure that we've pitched it right for New Zealand, given our size, given the movements that are taking place really rapidly around the world.
Yeah, we don't really have the luxury of time to consider and discuss and debate. Action is what we heard from the first panel. We really need to lean into this. And Michael Stiersson, you were saying, well, how about we have this 6-month time frame where we can actually come up with a framework? What was your guys' reaction to that?
I definitely think directionally makes sense. Why, and I was actually talking with a colleague after that panel discussion, why as a very risky nation, and whether you believe we're the number 2 most riskiest jurisdiction on the planet or within the top 10, we're certainly within the top 10, why we haven't got our collective acts together to actually have a centralised view of perils and risk across the country is it's one of the things we should be doing. I think part of the reason is that we've largely entrusted a lot of those views to the 66 or 67 councils that we have up and down the country. So we have disparate views of what that risk might look like in different areas. And that's not looking to be disrespectful to the councils. That's just, I think we need to mobilise and have a single view. And that will catalyse, I think, the conversation and will also help shore up the supply of capital from overseas. So I definitely think that's something that we could take the lead on. I suppose my area of concern is the insurance industry is being asked to do a lot.
A lot, too much?
Well, it's that whole concatenating impact. So, and I won't relitigate what I shared before, but we're obviously doing a lot to fund arms of government through levies, etc. You heard the Honourable James Shaw said we need to do the heavy lifting on adaptation. I suppose the concern around climate-related financial disclosures and what that regime could, or where it could potentially take us, is the industry, and I hope it doesn't, is the industry then becoming the official inspector or police person of Scope 3 emissions. Because, as Christian said, insurance is a contract of utmost good faith. It's built on trust and confidence. And if we start to lose the trust and confidence of our clients because they see us as starting to collect information for reasons other than underwriting risk, then I think we will lose their faith and their trust and confidence in us. So I think the best way we can serve that climate-related conversation is by becoming one of the key conduits of a central repository of risk-based information and data at a national level. That will involve working with central government and banks and with local government, but I think we can take the lead on that. And I know this is something Chris has, coming into the role, has been very hot on in terms of what is the ICNZ doing to shape up our own data strategy and how do we play more of a leadership role in that. So I'm really hopeful that that work will take us down that path.
What did you think, Helen and Joe, of James Shaw saying central government is just not on top of this?
I think that actually the role that the government, I think, can set is a little bit of a, here's the North Star we want to get to, and then getting the right people together who've got the decision-making capability but have got the expertise for the respective components of this machine that need to work together to solve this problem, I think is something that there could be much more requiring to come to the table. One of the sort of most radical pieces of change I've been involved in my time in 17 years in the industry was after the EQC Act challenges that we saw come out in 2010 and 11 through the earthquakes, and then the entire statute needed a radical rewrite, which in 2018 basically Treasury and MB got a bunch of insurers together with some economic advisors and basically said, here is the problem to solve, you solve it. And we did, and came up with a answer that everybody was slightly unhappy with, which meant it was the right result, I think. And that was what really radically and quickly resulted in change. Otherwise, it would have just been something we kept talking about needing to do for years. So I do think there's a stronger expectation that government can set, including a commitment to come to the party as well. I think that's really what's lacking at the moment. There's a lot of we all need to work together. No one's disagreeing with that. It's okay, so what, when, how, who, and what's the time frame and what's the outcome we're all required to achieve. And I think we'd see something a bit faster, to be honest.
What, when, how, who? What's your response, Christian?
Just reflections on the discussion here. For me, the Reserve Bank published a climate change strategy 6 years ago, and at the time the sort of question was, what on earth is the Reserve Bank doing talking about climate? Stick to your knitting, set interest rates, keep inflation down. I think now it's so much more accepted that it's a key risk fundamentally.
It is part of the knitting now?
It's absolutely central in terms of monetary policy, understanding changes in relative prices that come through climate change for financial stability. Climate risk feeds in directly to credit risk and market risk, liquidity risk, all of these things. So it's fundamental. For me, my view is that the more prominent risk-based pricing becomes, the more this comes to a head. in terms of the accessibility, and that's what ends up forcing the hand of others that do need to make decisions and provide clarity about where is the government, where is central government, where is local government on this. So I think that's why we've been open about the benefits of risk-based pricing and the right incentives that it creates, the right transparency that it provides. And so, but that's an uncomfortable path to take to get, that sense of urgency around the decision making, particularly around adaptation.
Any responses?
Yeah, just on the question of whether or not the government sort of on top of this. So in the climate change space specifically, I won't talk broadly about regulation as it pertains to all of the aspects in insurance, but last year the Minister for Climate Change, Simon Watt, who I think is going to be speaking this afternoon, made two announcements that related to our work. One was the development of a sustainable finance taxonomy, and the second was the co-design with us of a sustainable finance strategy. So that's a strategy for financing sustainability outcomes, right, for New Zealand. So that's happening now. The taxonomy is underway. Taxonomy helps to define what is the economic activity in a particular sector that is green or that's enabling green activity. So that's underway for agriculture and forestry, and then we're working with officials now on the strategy. And the strategy is that coherence, right? It's the way of understanding the role of regulators and the different frameworks in the context more broadly of where we think the country needs to go to be able to finance those long-term outcomes. So I don't think the government necessarily has the answer, and some of this work started when James Shaw was the climate change minister, but certainly the government is currently looking at, from an adaptation perspective and a broader sustainability and climate perspective, what is the role of the financial sector and what can we put in place in order to create some of that coherence and clarity.
But is the best way to do that, sort of encourage that kind of change, to require reporting on statistics that aren't yet really collected, and put personal liability on directors to start to have a conversation around a aspect over there when we've got this much larger sort of system problem that everyone can identify, but we're so busy doing other bits and pieces, we're not necessarily putting the right people with the right attention on the right things?
I think that's exactly the point. So we had disclosures, first cab off the rank, and you really need to understand the disclosures in the context of availability of decision useful data or taxonomies or, more broadly kind of what you want the economy to be doing in 2030, 2050. So I think that's sort of the point. And there are people here, Bryce is one of them, in the front here, who worked on a roadmap 5 years ago now to sort of establish what is the role of financial institutions in long-term sustainability for New Zealand. And the key recommendation there was from industry was that there needs to be that strategy and that coherence so that all of the component parts then fit together, and you've got groups like the Council of Financial Regulators who can sort of see across everything, and there's coherence is the word, or coordination.
Okay. Satisfied, Helen? Yep. Okay, good. We've got a question here, Adam. CoFR is about to push more cost into the insurance industry. I think you're going to have quite a few thoughts about this. Who ultimately do you think will be end up paying for this? The policyholders?
They will, to the extent, which goes back to that dynamic before around each individual insurer's operational expense ratios. But I think the thing in the way that from an FMG perspective, because we're obviously an end-to-end insurer, so we're direct distribution, so we have licensed financial advice providers as part of our employee workforce. And so for us, and being a mutual, again owned by our members, we see CoFR as largely codifying what we do, the way we operate anyway. There's a cost and an overhead that comes with it. That's obviously on us then to ensure that we're operating as efficiently and as effectively as we can. I think those are the things that we can control, and we're comfortable with that. It's the things that we can't control that are causing us more friction, I think, with our clients, our members and our owners, than the things that we can control.
Okay, we haven't got much longer for our panel, so I just want to ask you all any more thoughts on the regulatory environment that you'd like to share before we wrap. Jo?
I think I've given a lot of thoughts already on this.
Okay,
probably.
Helen?
Yeah.
Yeah, I just think the continued conversation, let's all just, lean in to get that balance right. It's not about none, it's just about getting it right. And the active management and sequencing and prioritising, not just doing everything at once.
And Christian, offline, I'd love to have a conversation around 1 in 1,000 and whether we still need to be at that level or not, but that's a much bigger conversation.
Well, why don't we've got a minute or two. Is there a particular question that you would like to pose to Christian?
Just, I get why we have it, I get why it arose, but you look globally and we are the exception. There are plenty of other very risky jurisdictions that operate at 1 in 200 or 1 in 500. And it does make a difference. Again, it talks to the amount of capital we have to hold, it talks to the amount of reinsurance we have to buy. And again, as a mutual insurer that's very much focused on trying to keep things affordable, it is another cost. It's a well-serving cost, and I get that. But yeah, it's a question that I think we are just raising more often because of all the other pressures.
So pose it as a sentence. What's your question to Christian?
Is New Zealand still risky enough to justify 1 in 1,000 compared to other jurisdictions?
Yes.
Please expand.
My finishing point is that it was going to be about consultation, and we need to have workshops and good discussions and things, but I've kind of, we've run out of time. But
Not quite. Do you think there is enough risk? Are we taking enough risk?
As
a country, yes. In the regulatory environment, are we too focused on regulation? Are we actually are we constraining people?
The way I think about it is that Adam actually made a really good point about CoFR. That in some ways you care about your clients, you care about your conduct, you're doing a lot of this stuff already. The regulation just provides a bit of framework and a bit of consistency and transparency about that. And I think the same way around prudential regulation. If there was no prudential regulation, insurers would still care about how resilient they were to risk. They would still be holding capital, they'd still be risk pricing, they'd still be managing this. Then having a prudential regulatory framework just provides some consistency around that. Also, that the private and social benefits and costs aren't always the same, and that's the other big motivator for prudential regulation, is that on their own companies might not hold enough capital to manage that risk that's not only going to affect them but it's going to spill over to the rest of society. And so that's where our role comes in.
Okay, so your final thought with 10 seconds is, what do you want to say?
Oh, I just want to thank the panel for the conversation, and let's keep it going. Our consultations are genuine. There is so much brain power in this room around the insurance industry. We don't have the perfect knowledge. We don't have the final word on it. We learn a lot from the engagement that we have with the industry. Being the prudential regulator from the insurance industry and the banking industry actually helps us learn things from each side of the fence, and there's a lot of things we've learnt from the deposit taker world that we can translate into the insurance world, particularly around the way we engage, the way we consult, the way that we workshop through issues together.
Great. Thank you so much. I'd like to thank you all as well. Christian Hawkesby, Adam Heath, Helen McNeil and Jo Kelly. We so appreciate you being with us today. A round of applause, please. We've got a little gift.